Good. Here's another question to combat boredom. Swazi traders on 28 February 2011, the last day of the accounting period, the following balances appeared in the books of Swazi traders. Like if you have the balance sheet section, capital, as at the beginning, drawings, land and buildings, vehicles at cost price, accumulated depreciation on vehicles, trading stock, debtors control, allowance for credit losses, bank, petty cash, cash float, creditors control, and then VAT with a credit balance of 4,400. And then important, the VAT rate that you have to use equals 14%. Now the income statement items, sales, purchases, sales returns, rates and taxes, salaries, bank charges, rent income, discount received, discount allowed. Now once you see those two, then you must immediately, the bell should start ringing and you should know that these kind of accounts does not appear anymore in our life, so I have to get rid of that. So before we even go on, discount received is all to do with purchases. So if we have received discount of 1468, it will be a credit balance in the income account. So if we're going to take it out, we're going to debit that account and we're going to credit our purchases account. Discount allowed got something to do with sales. So once you see that 1740, it's got a debit balance. So if I want to get it out, I'm going to credit this account 1740. I'm going to debit sales, so I'm going to deduct it from sales 1740. Also, what you can do straight away is things like sales returns. Sales returns, you have to close off against sales in any event. So this got a debit balance. I'm going to credit this account and debit my sales account. So I'm going to reduce my sales account with the amount of 8520, and that will also then disappear out of our books. Good. Rates and taxes, salaries, bank charges, rent income, credit losses, stationery expense, packing material, telephone insurance, water, electricity, and carriage on purchases. Then they give us a lot of additional information. They want from you at the end of the day to do the statement of comprehensive income for the year ended 28 February 2011. Now you will see in the second semester we're going to do IS1 and you have a choice. You can call your income statement the statement of comprehensive income if there is any other comprehensive income, which there isn't in this case. So actually all they want from you is the statement of profit or loss. Only the following notes to the statement of financial position: your trade and other debtors, trade and other creditors. Round all calculations to the nearest rand, and the VAT rate is where applicable 14%, which we've already seen. Good, so let's start with our adjustment entries one by one, and now we have to take note of the trade receivables and trade payables in our statement of financial position as well, because we have to account for that. On 26 February 2010, a debtor, Aimulazzi, returned merchandise with a sales price VAT inclusive of 821 Rand. This transaction has not yet been accounted for. So if we take the 821 Rand, we take out the VAT, and we see that the VAT exclusive amount is 720 Rand. So what is going to be our accounting entry? It is a sales return. So we're going to reduce our sales with a 720 Rand. The VAT is going to be the 720 Rand times 14%, which is 101 Rand. So that is going to be in our VAT control account. I'm going to do the calculations in a VAT control account here. I'm going to debit that account with 101 Rand. So if it's got a credit balance and I'm going to debit that account, I'm going to reduce that balance with 101 Rand. Now guys, be careful for VAT, because VAT, you get very easily confused. Must I plus or must I minus? Therefore, I would strongly recommend that you put a little D or a little C next to the figure so that you know when you're going to calculate the final balance that whether you have to add or whether you have to deduct that from the original balance. Good. Remember, VAT control can either end up to be a debit balance, which is then going to be shown as part of trade and other receivables, or it can end up as being a credit balance, in which case it will be shown as part of trade and other payables. And you are required to do both those notes, so we have to keep track of the VAT. So we're going to debit sales with 720 Rand. We're going to debit our VAT control with 101 Rand, and we're going to credit our debtors control, sales returns, the full invoice amount or the credit note amount of 821 Rand. The second transaction, our closing inventory, trading stock 40,000. Now going back to your income statement, there clearly you can see purchases, that is a debt giveaway in any event. And then if I go to my statement of financial position, you'll see that I have opening inventory there. So that is just the last straw, obviously a periodic system. So I'm going to show my cost of sales as opening inventory of 39,960 plus purchases, whatever the final amount is going to be. Use no purchase related cost as I can see that, less closing inventory, which will then be the value of 40,000 Rand. Good, then stationery on hand at the end of the period is 364 Rand. And what I'm going to do is I'm going to reduce my stationery expense with a 364 Rand, and I will transfer that amount to an inventory consumable stock figure. They don't ask inventory, so I'm not bothered about the counter leg. Packaging materials, 112 Rand, so I'm going to credit again my expense account with 112 Rand. I will debit in consumable stock inventory account 412 Rand. Again, they don't ask the inventory, so I'm not bothered with that part of the answer. An amount of 684 Rand was received from a debtor whose account was previously written off as bad. The accountant credited the debtor's control account with this amount. Correct the error. So he debited bank and he credited debtor's control. What should he have done? He should have credited credit losses recovered, which is an income item. He should have credited VAT, and he should have debited the bank with the full amount received. So the bank side of the story is right. The first thing that we have to rectify is the debtor's control account. So we debited bank and he credited debtor's control account. So we're going to debit debtor's control account. We're going to debit that. Its balance is going to increase with a full amount of 684 Rand. Then we want to create a credit losses recovered amount. So we don't have credit losses recovered. So let's create one. And that credit losses recovered is going to be the VAT exclusive amount. So the amount that was received from that debtor was 684 Rand. We're going to divide it by 1.14. That is going to give us our credit losses recovered, and that is going to be 600 Rand. Good. The difference between the 600 Rand and the 684 Rand received is obviously VAT. Now, is it VAT input or is it VAT output? And this is clearly VAT output because we've received the money, so it's going to be an 84 Rand there, which is going to be a credit. So we have to credit that account with 84 Rand, therefore we're going to add that to the balance. Write off J. Jim's outstanding debt of 855 Rand as irrecoverable. So what are we going to do? We're going to credit our debtors control with a full amount of 855 Rand. The VAT exclusive amount is going to go against our credit losses. So if we're going to work out what is the VAT exclusive amount, 855 divided by 1.14 equals an amount of 750 Rand. So our credit losses is going to be increased with 750 Rand. The balancing figure, i.e. the 14% of the 750 Rand, is going to be 105 Rand. and that 105 Rand is going to be a VAT input. So therefore, we're going to deduct the 105 Rand from our VAT control balance because it's a debit against that account because it's VAT input. Good. Now the next one is adjust the allowance for credit losses to 10% of our outstanding debtors. Now let's quickly check our outstanding debtors at this point of time. It is the 19,480 less the 821 plus the 684 minus the 855. So that gives us a balance of 18,488. 10% of that equals 1849, but remember we have to take out the VAT out of that balance. And if we take out the VAT, it means that we actually want an allowance for credit losses at the end of the year of 1622. We have to go back and check whether we have an existing balance. And yes, we do. We have an existing balance of 1170. So that means we want to up that balance. We want to increase that balance with an amount of 452 Rand. So what is the entry that we're going to pass? We are going to debit our credit losses adjustment account with 452 Rand, and we're going to credit our allowance for settlement for credit losses with 452 Rand. So our allowance for credit losses, we're going to increase with 452 Rand. And then we're going to have this adjustment account, which can either be separately shown as adjustment for the allowance for credit losses, which is going to be then a total there, and it's going to be a debit. Oh, shucks. A debit of 452 Rand. So indicate for yourself whether it's an income or an expense. Otherwise, you can show it incorrectly. Now, once more, I hope that you have already written down your template. And if you did write down your template, it is easy to go and slot it in exactly at the right place. So if you have now an expense here of 452 Rand, you can either add it with that 750 there, or you can show it separately as 452. But either way, you can immediately write it in as an expense item on your template. Good. An insurance premium of 1117 inclusive of VAT was paid on 1 December 2010 for the period 1 December 2010 to 30 June 2011. So guys, that is a 7-month period. So the amount paid was 1117 divided by 1.14 gives us a total of 980 Rand. That 980 Rand was for a period of 7 months. How many months was actually prepaid? So 980 divided by 7, and there was a number of months, 4 months, that was prepaid. So that gives us a total amount of 560 Rand, which was a prepaid expense. So if we want to add it, we're going to add it to our insurance premium. It was prepaid expense, so we're not going to add it. We've paid it, and it belongs to the next financial year. So our insurance there, we're going to reduce with 560 Rand. Good. Then what is that 560 Rand? That 560 Rand equals prepaid expenses. Now, if you've written down your template for trade and other receivables and trade and other payables, then you can slot it in directly in your trade and other receivables note, because prepaid expenses has got a debit balance. I credited insurance, I debited prepaid expenses. So under trade and other receivables, you will show the 560 Rand. What about VAT? Now, VAT was taken care of when the payment was made. So all that we have to do now is to do the adjustment year-end entry, where we're going to rectify our insurance expense to exactly the amount that belongs to the current financial period. Another annual insurance premium of 1,800 Rand from an insurance firm is not registered for VAT was payable on 1 February 2011 for the period 1 February 2011 to 31 January 2012, but it is not yet been paid. Now, what is the expense that actually belongs to the current financial period? The expense that belongs to the current financial period is 1,800 divided by 12 equals 150. So it is only for the month of February. We haven't paid it as yet. We haven't done anything with that as yet. So what are we going to do with that? We are just merely going to create the expense. So we're going to add it to our insurance plus 150 Rand. And then it is accrued expenses that we have to credit. And accrued expenses, guys, is part of trade and other payables. So it's a credit. We're going to debit insurance. We're going to credit our accrued expenses, and that is going to be with 150 Rand. That 150 Rand is the liability that we have in the current financial period. Not the whole year. We're not interested in the whole year. It is only this month that we have a commitment for 450 Rand, and then that is also our insurance charge for the current financial month. And our month is the end of the financial year. So obviously we're not going to make provision for the whole year's payment because it doesn't belong to this year. Right, rent income amounted to 506 Rand per month, VAT exclusive, until 31 August 2010, when the premium increased with 15%. So our financial year started at the 1st of March. Up to the 31st of August, which is also the 1st of September, equals 6 months. So for a period of 6 months, we have paid an amount of 506 Rand. And 6 times 506 equals an amount of 3036. Then for the remaining 6 months of the year, we have actually paid 506 Rand multiplied by the escalation of 15%. So for the second 6 months, it's 506 times 6 times 1.15 equals 3491. So what is the total amount of rent income that we should have had in our income statement? It should have been the 3036 plus the 3491. So that gives us a total of 6527. Now if you go to our rent income here, we have a total of 7692. So we say, well, we want to do the adjustment 7692 less the amount that we should have received for the current year, which is 6527, give us then the adjustment entry of 1165. What is the 1165? 1165 is our income received in advance. So income received in advance is part of trade and other payables. So you must remember, and if your template is already there, you can add it already in your template, and that amount being 1165. Good. What about that? Guys, we've dealt with VAT when the payment was received. So VAT has already been taken care of. The bank statement was received on 28 February. The following items must still be recorded. The cost of the checkbook, transaction fees, minimum service fees. If I add those three together, it gives me a total here of 171 Rand. Now those is VATable fees. So those fees include VAT. So the VAT exclusive amount was 150 Rand. So we're going to debit our bank charges, so increase our bank charges with 150 Rand. we're going to post as VAT input there 21 Rand. So that is a debit. That's why I'm going to deduct it from the credit balance for the bank charges. And then the counter leg of 171 Rand obviously needs to be posted against our bank account. We don't need the bank account, so it's not really necessary to bother with a bank account. Then I said, then we've taken care of those three items. Then there was interest on overdraft of 140 Rand. Now, interest is not subject to VAT. We don't have interest paid here anywhere. So you're going to add that also to your income statement, interest expense, and that was being 140 Rand. Then we've taken care of that one. Now, the last thing there is a monthly stop order of 400 Rand in respect of the owner's personal loan. Because that 140 Rand obviously would have gone off our bank account, and the 400 Rand would have gone off our bank account, so we would have credited bank and we would have debited the drawings. Now, if you put drawings in your income statement, you should kick yourself, bang yourself, your head against the wall. You have to do all kinds of ugly things with yourself because drawings is not an income statement item. It is part of equity and it reduces our equity. So basically, you could have ignored that 400 Rand altogether because it doesn't appear in the income statement and it isn't part of trade and other receivables or trade and other payables. Withdrawal, the owner contributes 3,000 Rand to the business. The entry is not reflected. Now, once more, it's got absolutely nothing to do with my income statement, and it's got absolutely nothing to do with trade and other receivables, trade and other payables, so you might as well ignore that. If you did use this in your question, and if you want to have to use it, you would have debited bank and you would have credited capital. Depreciation of 333 has been calculated correctly, but has not yet been accounted for. So obviously you're going to add here depreciation of 3333, and in your template, you're going to add depreciation charge as one of your line items with an amount of 3333. Good. Number 11. It is the business policy to group all creditors and accounts payable together by discussing it in the note. What we do. I hope it is the policy because you have to do it according to IFRS, and the same thing applies to debtors and accounts receivable in a note. You have to do that according to IFRS. So 11 and 12 is really a bit of useless information. You should know that for yourself. So let's quickly go to the answer then and have a look exactly what our income statement is going to look like. Good. Again, Swazi 1 Trader, Statement of Profit or Loss and Other Comprehensive Income for the year ended 28 February 2011. Sales. Now, if you go back, you're going to pick it up easy. 79,279.72 less 1,740 less 8,520 less 720. Then cost of sales, opening inventory, they gave it to you. Purchases. There's only one adjustment entry that we've passed against purchases, and that was the 1468. Then our carriage on purchases, there was no other entries that we've made against our carriage costs. There it is, carriage on purchases, 270 Rand. Good. And then our closing inventory, they gave us the 40,000 as well. So we could have worked out our cost of sales and we could have worked out our gross profit. Then our other operating income, the rent income, is the one that we've calculated. So rent income was 6,527. It's just a 1 Rand rounding difference, 6,528. Our credit losses recovered, 600 Rand. If we go back here, credit losses recovered, 600 Rand. That is up to there. Then our operating expenses, rates and taxes is exactly the same. Salaries, no adjustment entry, exactly the same. Bank charges, if you go back, bank charges was a 620 plus the 150. Credit losses is going to be the 640 plus the 750. You could have added this 452 there, or you could have shown the 452 as a separate line item, but it is an expense. In total, it makes up 1842. Stationery, we just took out the closing balance, so it's minus 364. Packaging material, we took out the closing stock balance of 112. Telephone, it's exactly as in the question, no adjustment entries against that. Our insurance was our total amount of 1640 less the 560 plus the 150, which gives us 1230. Water and electricity was 4838, they gave it to us, and then depreciation, we added it to 3333. Profit before finance charges 1192 and 191, and then we've added here at the bottom, interest expense of 140 rand. Good. Now our notes, trade and other debtors. Our debtors control, we've already worked out our debtors control account when we worked out our allowance for credit losses, 18,488. Our allowance for credit losses will be our closing balance of that account now, and that is going to be the 1622. Remember, the movement of 452 goes to the income statement. The amount that we want the balance to be at the end of the year, that goes against the trade and other receivables. 1622 give us net trade debtors of 16,866. Then we had prepaid expenses. Remember there, prepaid expenses, which is a debit, part of trade and other receivables, 560 rand. Total trade and other receivables, 16,426. Trade and other creditors would be our creditors control account. I don't think we've passed any adjustment entries against the 29,564. And then we had a couple of other entries, accrued expenses, 150, income received in advance, 1165. Now, the one that we have to calculate now is our VAT control account balance. Now, if we look back to our calculations here, our VAT control balance, you would have started with 4,400, less 101 plus 84, less 105, less 21, and at the end of the day, that will give you a final balance then of 4257. And if you add that all together, that then gives us a total trade and other payables of 35,135. Good, and that is the end of this question.